The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to GCV Analytics webinar. Today we're kicking off for 2019 with a webinar on the transport and mobility space. And today we are very pleased to have with us Dr. Ulrich Quay, Managing Director of BMW I Ventures, with us. Ulrich, welcome.
Thanks for inviting me.
Just a very brief introduction. Ulrich is Managing Director of BMW I Ventures. He's been Managing Director of that venturing unit since 2011. He's running a 500 million euro investment fund, which is focused on automotive AI, cybersecurity, connected car, fintech, mobility, e-mobility, and many, many other areas. Ulrich holds a doctorate degree in international contract law by University of Freiburg, and it's true pleasure to have you here with us once again, Ulrich. Thank you so much. Now, before we move on to the juicy data part of the webinar, I'm going to give the word to our editor-in-chief and founder, James Mosen, for a few brief introductory remarks. Jim?
Well, thanks, Kellyanne. And once again, I really appreciate you setting up and the hard work that you do to prepare for these webinars and prepare all the data. And obviously, Ulrich, wonderful to have you joining us on the webinar. Really excited to hear some of your insights, and you've really been a sort of visionary in this space. So we're looking forward to learning a lot. Just to give it a little bit of context about why we do these webinars. Obviously, global corporate venturing is well known to many of the audience, but effectively we act as a trade paper for the corporations engaged in the entrepreneurial ecosystem. We try and very much help corporations understand how to invest directly in startups and also indirectly through VC funds. And through the magazine, the data we collect, we try and understand who does corporate venture and what are they doing. And that feeds through the information into the analytics part, which Kellyanne is running. And then we also do the sort of training and sort of management through the academy, and then the top 20% of corporations are responsible for about 80% of the 2,500 or so deals that we see each year that corporations involved with. It's about 180 billion or so that they do, and the top 20% really drive the vast majority of that activity. And they come together through the GCV Leadership Society to connect with peers, understand, and hopefully help drive the industry, bad pun intended, so apologies, help drive the industry into a much more sort of proactive, forward-thinking, and engaged part of the entrepreneurial and innovation capital ecosystem. But Global Corporate Venturing is just one of the publications we do, with Global University Venturing and Global Government Venturing, looking at those ecosystems. Global Government Venturing will be renamed and rebranded to Global Impact Venturing, as we've partnership with USAID to understand how the corporate impact space and the wider impact community is coming together through challenges and missions to sort of really make the world a better place, if we can see. So that's a little bit of context of what we do and why. Obviously, our next big event, which I think, Ulrich, you said you'll be attending the sort of Rising Stars dinner at the Monterey Aquarium just beforehand. But the GCVI Summit we do on the 30th and 31st of January, brings together 700 or so of the largest corporations. That's about $6 trillion plus of aggregate annual revenues from the corporations attend. So everyone through from Amazon through to, I don't know, Google and Intel's, Pfizer, all sectors, all stages, all regions are well covered. And that's about 200 billion plus of venture assets under management to come together, really understand how to do deals, what they're doing, and why. So that's a little quick sort of background about why we pull together these webinars, but really it's about the community understanding. So I will hand over to Kellyanne, and you will say a little bit more about analytics and what we take it from you.
So yes, thank you so much, Jim. So regarding analytics, as Jim mentioned, we do report a lot of deals and a lot of moves of people, a lot of new funding initiatives happening in the corporate-backed venture capital space. And we tried to collect all that data and turn it into something more or less operationable and visualizable. And we have the GCV Analytics platform, which, if you are interested in, you could find out more about it at www.gcvanalytics.com, or reach out to me. Now, before we move on to the data on the transport and mobility sector, I would like to take a brief look at the investment activity in the corporate venture capital space, as we had a record-breaking year in 2018. So as this chart shows, in 2018 we had a record-breaking year in terms of both number of deals. We had 2,775 deals, all of which had at least one corporate backer in the syndicate, and all of those deals were worth a total of over $180 billion. So in comparison, the previous year, 2017, we had a little over 2,400 deals worth $116 billion. And whenever I mention dollar figures here, these are the sum totals of total amounts invested in rounds, not amounts invested just by corporates. However, these figures do give us a great idea as to the immensity of the whole business, of the whole industry, and also as to how valuations have been going in recent times. Obviously, the number of deals has not increased nearly as much as the total dollar figures, which suggests here that valuations have been going up. And if we were to use the language of economics and the language of business cycles, we seem to be clearly in the expansion phase, so to speak. Now, whether we've reached a peak and whether there will be a correction, I would not try to give a forecast on something that no one can really reliably forecast. But that will remain to be seen. That will remain to be seen, and it could mean plenty of things in terms of both opportunities and challenges for CVCs as we go along. It's hardly surprising that we see this many deals, because in terms of our broader definition of corporate investors, meaning any corporate that has taken a minority stake in a startup, in a young, promising business, we saw over 1,500, close to actually 1,600 such corporates around the world last year. And as Jim mentioned, however, this figure should be taken with a pinch of salt, because only about a fifth of them, or less, about 20% of those actually account for the vast bulk of the 27,000+ deals that we tracked last year. The exits involving corporates have been evolving in terms of their mere counts, have been actually quite stable. But last year we did see that the exits involving corporates actually amounted to $82 billion, which was a significant increase over the 2017 figure, which stood at $48 billion. So yes, again, this is obviously suggesting an expansionary phase development, obviously suggesting valuations going up. In terms of funding initiatives, and by that we mean any newly launched CVCs, any new funds, VC funds with corporate LPs, any corporate-backed accelerators, incubators, etc. They seem to be going down steadily, not by much, but steadily going down since 2016, when they reached a peak at 332 such initiatives that we tracked and reported on the pages of our magazine. but last year we only reported 273 of them. As you can see, most of them from North America, Asia, and Europe. Now, on to the transport sector. And the little data overview that I'm going to give here, and I would like to engage Ulrich on some of the questions that I'm going to be talking about as we go along, and to make this a bit more interactive. So let's dive into it. The way we understand and we define the transport sector, as we cover one of 10 sectors in each of our monthly issues in the magazine. It encompasses things like ride-hailing and car sharing and rentals, connected autonomous and electric vehicle techs, vehicle marketplaces and platforms, public mobility and parking, vehicle hardware and maintenance, and other types of transport, including air, marine, and rail, etc., etc. However, despite the very broad definition of transport, it is quite clear that the major disruption that has been making the headlines in recent years has happened mostly in the automotive space. And even though if we try to estimate the total size of the global transport market, including things like rail, marine, and air, and so on, it stands at over $6 trillion. It is really, like I said, the automotive side of things that has gathered most attention, and some fellow journalists have even coined buzzwords and abbreviations like ACES, which stands for autonomy, connectivity, electrification, and sharing, to denote this side of very fascinating disruption that's happening here. And because this disruption is still very much in budding stages, I guess it's something very dynamic. It's somewhat hard to estimate the total size of the autonomous technology ecosystem or of the electric vehicle ecosystem. Although some have estimated the autonomous tech ecosystem at about $80 billion. Now, these new developments, all that disruption has been enabled by advancements in artificial intelligence and things like sensors and battery technology. And there's almost no doubt that the positive externalities this disruption could lead to could be greatly beneficial to not only to consumers but to society at large. I mean, anything from reducing road fatalities to reducing carbon emissions and having a positive impact on climate change are potential positive externalities of all this. However, these fascinating technologies are still within the venture capital space because they are perceived still as risky. They're not quite there on the market yet. And one of the fundamental potential stumbling blocks of these technologies is actually consumer perception. So according to some surveys of US consumers, about half of them think that autonomous vehicles are unsafe. In some major markets like China and Germany, there are a lot of consumers who are concerned about things like, would I be able to drive on a single battery charge for a whole day? Or would I be able to find a charging station for my electric vehicle? So those are particularly vexing issues within that space, and I believe Ulrich would probably agree with me. Ulrich, if I'm not mistaken, you guys funded a company that's called ChargePoint, and you are very much closely following the space of charging stations and battery technology. So would you say a few words about that?
Yeah, absolutely. We had actually two investments in charging companies. One of them based in UK, ChargeMeister, that was sold to BP early last year. And the other one is ChargePoint. We invested in 2013 for the first time. and they've just raised a pretty sizable round at the end of last year, which made them a unicorn. So happy with the development of the company, and when we invested, it was obviously not clear yet which extent the electric vehicles will make it, and that uncertainty seems to have gone away, and investors seem to be more willing to support the company than was sometimes in the past when future of electric vehicles was not that clear as it is right now.
I see. So you would say that the future of these technologies is becoming more clear as we advance in time, and basically you are more comfortable doing investments in those areas.
I mean, there's still challenges, but it's the biggest uncertainty when we invested was how fast will electric vehicles be adopted, and I think that question is answered with clarity in the US. You only have to look at the Tesla sales figures, and also I think with announcements from various OEMs about launching a large number of electric vehicles over the next 5 years. I think that answer the model strategy of OEMs clearly indicates that electric vehicles will be a key component, and that takes away the biggest uncertainty. I think if you look at the charging sector, there are still many things that are challenging, that are making it difficult to scale. But so far, the revenue and the development of ChargePoint is extremely positive. It's a capital-intensive business, so it's key to be able to raise money and to have a team in place that can do that. And so that's for ChargePoint. That's certainly the case. So for us, I'm not sure if you look at investments right now. I find it a little more challenging because valuations are. If you want to invest in a new player, the question is, can they compete with the ones that have the deep pockets? And if you want to invest in the ones that have already are quite advanced, then you have to ask yourself, what's the return profile? How does it look like? So I think from an investment perspective, personally for me, it has gotten less attractive compared to a couple of years when there was more uncertainty and lower valuations, but that may be just me.
All right, that's very valuable perspective of yours. Thank you for sharing it with us. In terms of also of consumer perception, another problem that's often found according to consumer surveys is a sizable part of consumers are still very much unwilling to pay a premium price for vehicles with autonomous or rather semi-autonomous capabilities or hybrid vehicles and that sort of thing. But that's expected to change as the cost of these technologies goes down over time. And another very interesting finding of consumer surveys that I was actually fascinated with was that if autonomous and electric vehicles were to become massified on the market, most consumers would probably choose well-established vehicle brands. So that means definitely potentially a lot of opportunities for BMW, which is one of the most established vehicle brands in the world, no doubt. So yeah, that was just another thing that I found very fascinating. But let me move on with the presentation, and I'll get back to you on another interesting point as we go along. So in terms of other general trends, we know that the automotive market itself is expected to exceed 100 million units in 2019. This means 100 million fully assembled new cars are expected to be produced this year alone. And we have to be mindful that this is all in the context of millennials preferring sharing and using over owning. This is still happening, and this is very much expected to happen. So the viability of businesses like e-commerce platforms selling vehicles, whether new or used ones, or other online service platforms for motor vehicles, we're expecting that part of the transportation sector to be also very much continue drawing the interest of corporates. And Ulrich, correct me if I'm wrong, but I think your latest announced investment was in Techion, which is a cloud platform for retail of vehicles, if I'm not mistaken. So how would you comment things on that space?
Yeah, it's true. We invested a couple of months ago. The announcement was last week. So the fact that we invested in software that's relevant for dealers indicates that we expect that the dealers will still play a key role in the foreseeable future. We think that full autonomy and moving away from ownership entirely into access to mobility is still there's still a lot of challenges. There's still a lot of good reasons to own a car, especially when you have a family, you have a dog, and just thinking about my wife driving around every afternoon from picking up the kids to school to taking them to soccer and horseback riding. So I couldn't envision our family, for example, not having a car, because we constantly need one throughout the day. But of course, there will be an impact if there's easy access to mobility without owning a car. There's still it will have an impact on sales. Or on the other hand, there's also an increase in mileage driven, which is good news for OEMs, because the people it will be easier for people to use vehicles instead of for example, using public transportation, which is not always the best solution to get around. There are alternative ways without owning a car, and obviously we have invested a lot in this space, car sharing, ride sharing, and other micro-mobility solutions. So there are a lot of things coming up, a lot of interesting opportunities, but we think that right now people are still want to still own vehicles. They want to still, sales platforms are still relevant. Dealer software is still relevant, and we think that this is going to stay relevant for some time to go.
Okay, and in terms of the ride-hailing, which is my next point here, ride-hailing does face some regulatory, legal challenges. That there is some societal friction, obviously, with established ride-hailing services, meaning taxis, right? But there are also some concerns about the profitability of business models in this space. The much expected IPOs of Lyft and Uber for actually the first half of this year, it seems like they're going to be slightly delayed. So what's your whole take on that fascinating part of the transport space?
Personally, I think it's going to be very relevant. I think that this whole market of ride sharing offers, increases individual mobility. People who were not able to be mobile in the past are able to do it, whether it's older people or people without a license. We think that if you look at market studies, the prediction is that mobility as a service is going to be a massive market, and that's what the investors are betting on. One perspective that I have is that sometimes you hear the argument, once we have autonomous vehicles, the whole companies will take off and be very profitable. I'm not entirely convinced that's the case, because I think drivers today are the big barrier to entry for other people to enter the market. So if you want to now create a new Lyft or new Uber, you have to spend billions to buy yourself into the market. And this is going to change, or this is changing with autonomous autonomous vehicles, whenever that happens, vehicles without a driver, because as long as you have someone behind, some security person behind the wheel, it's not getting cheaper. But if this goes away, also the barriers to entry go away, and it will be easier for other people to enter a market. Someone like Waymo, I think they can launch without having a user group, because just people knowing that Waymo is offering services autonomously will be enough for people to join their platform. And if Toyota, BMW, GM, or someone else wants to launch a service, I think that's totally possible. It's challenging as long as you need a driver. It's costly, but if you don't even need a driver anymore, the barriers to entry go away. So there are some concerns about is this a race to the bottom? A lot of money that was spent in the sector, a lot of potential people interested in running those fleets. So there's certainly some uncertainty about how profitable this is going to be, but just wanted to make the point. I don't buy the argument once we have autonomous vehicles, this is becoming very profitable because the fleet owner can keep 100% of the profits. Yes, on one hand, but on the other hand, all your barriers to entry go away once autonomous vehicles is a generally accessible technology, which it will be at some point, and then that might have an impact on profitability.
I see. Thank you so much. In terms of other subsectors of transportation, aside from the automotive, we have seen intense competition in the air travel space, which has made incumbents look for alternative sources of revenue, including ancillary services and so on. So in that space, we are expecting corporate players from that space to be looking for any sort of new technologies that enhance customer experience or reduce operating costs in general. And in terms of developments in the broader public mobility space, which has been made possible by mobile devices and their ubiquity, this is expected to continue to grow as on the one hand, mobility and mobile services and mobile devices grow, but so do environmental and emission concerns among public authorities and the public. And of course, we are expecting that with smarter cars and smarter homes, we are going to end up having smarter cities as well. So that's another trend. Also to mention here is that some people do claim that we are likely to have air transport, electric powered air transport. We've seen an interesting deal in that space in Joby Aviation from JetBlue last year. Some people believe that we would end up having flying cars earlier than autonomous or electric cars on the road, but well, that remains to be seen. In terms of the data itself, before I move into the data, I would like to invite people from the audience that are here with us and following this webinar. If you do have any questions to Ulrich or any of us, please feel free to write your questions in the area that's specified for that. The webinar application, and we'll get to your questions as soon as we finish discussing the data on the slides. All right, thank you. So in terms of deals backed by the transport corporates, we tracked 148 deals by October 2018. That's as far as the sector report goes in the latest issue, because it was written late last year, so it doesn't capture November and December period. And most of those, as you can see, were in the United States, some of them in Asia and some in Europe. Of course, most of those investments were in technologies from the same sector, same transportation sector, meaning things in ride-hailing, car sharing, also connected and autonomous vehicle technologies, as well as of course vehicle platforms and vehicle marketplaces. There were some investments in the industrial sector in things like additive manufacturing, advanced materials, robotics, and drones. So that's definitely one thing to watch there. In the and also in the IT sector, those investments were mostly centered on AI and ML technologies being developed, as well as cybersecurity, because cybersecurity is going to be a vital part of a new automotive and mobility ecosystem with autonomous and electric vehicles, because the risks of malevolent parties hijacking vehicles that have no drivers are quite high. And I believe BMW, you guys did a deal in Clarity late last year. I think you announced it in about October, November, if I'm not mistaken. Would you like to say a few words about that, Ulrich?
Yeah, that is not so much about the security of vehicles. We're also looking at that space. We think that generally, I find some of the valuations a little challenging. There are lots of, especially Israeli companies that have with good technology that have a good shot at becoming one of the solutions, but we are still struggling a little bit to see who is the winner in the space, and at those valuations, you would like to have more certainty. Clarity was a cybersecurity solution for IoT. So it's mostly for factories, people preventing from getting access to the software in factories. So it's more production focused investment. We have not done any vehicle focused cybersecurity deals yet, but we are looking at a couple.
I see. Thank you. We did see quite a few investments in a wide range of emerging enterprises from the transportation sector. So that there are some of the subsectors that we already mentioned, of course, ride hailing, we saw Taxify, Grab, even in the airspace, Joby Aviation. Also from the industrial space, Desktop Metal and Sura Technologies, that are both additive manufacturing technologies. In the also Lime, for example, which is bike and scooter rental company. In the electric vehicle space, obviously Proterra and May Mobility, and so on. So a very, very wide range of enterprises where transportation corporates have co-invested in. In terms of the evolution of those investments on an annual, year-on-year basis, investments of transport corporates have been going up. And this chart is actually the one that was published in the sector piece in our magazine, which was as of the end of October. However, if we are to look at the data by December 31st, we did see that there was an upward trend in the number of deals done by transport corporates. So that's quite significant. Although there was a slight drop in terms of the total dollar figures, which I'm assuming it was probably caused by some valuation concerns that even Ulrich has expressed here. In terms of the top investors that we tracked last year, obviously we had Boeing, we had BMW, which we're happy to have Ulrich from here. Also players like Toyota, Daimler, and Hyundai. So it is very much all automotive-driven disruption and automotive-centered disruption, as we can clearly see here. There were other corporate investors investing in promising businesses, promising startups from the transport space. So we had companies like SoftBank with both its vision funds and other divisions investing in the space. Internet companies like Alibaba, Tencent, and Baidu, even their financial subsidiaries, Ant Financial, they're also co-investing with BMW, Daimler, and so on in all this space. And so they are in a way the extended corporates, so to speak, from the mobility and transportation sector, even though they're not strictly speaking transportation companies. Now, if we look at the evolution of startups of transportation startups, we see that the ones that have attracted most corporate rounds are obviously ride-hailing, connected, and autonomous, as well as vehicle marketplaces and the public mobility space as well. So I believe this trend is probably likely to continue in the short run, even though there are certain valuation challenges that Ulrich has mentioned. My general prediction would be that this will continue to be the case. There were various mobility enterprises that attracted corporate money, obviously not only from mobility corporates like Ford or BMW, but also from the likes of Rakuten or Booking or SoftBank and so on. So in here, of course, we see examples of public mobility apps like Move It. We see again ride-hailing apps like Lyft or Zoomcar, Ofo, Grab. We see Xiaopeng Motors, which is electric vehicle, and so on and so forth. The top deals that transport corporates did last year. Well, what strikes in this table is that the first three deals are all from the ride-hailing space essentially. So this is a huge chunk of where the dollars go into from this space. Also, we do see a few deals in companies like Hello Bike and Lime and Mobike. So mobility beyond the automotive and mobility in terms of alternative, cleaner, greener mobility is also on the rise in terms of valuations and in terms of deals that are being done. Now BMW did invest in Lime. So Ulrich, would you comment on that investment briefly?
Yes, would be happy to. It was our record closing. We closed within 10 days. So it was one example when our setup, our independent setup, was really important. Reason for investing was the growth figures. I personally came in skeptical when we started to look, but was convinced by fantastic growth numbers, by the fact that a lot of the markets that they're operating in are exclusive, and none of us has seen similar growth figures ever in any consumer-facing service. By the quick payback periods for scooters, by revenue numbers per day per scooter, and they're very strong team, and we also see some strategic opportunities. We have not agreed any details yet, but there's willingness on both sides, BMW's and Lime's side, to cooperate in the space. Obviously, Lime doesn't want to limit themselves to scooters. They want to go beyond that, and BMW could potentially be helpful. on the other hand, first and last mile mobility is obviously important for car sharing. BMW has a huge car sharing offer, in particular in Europe. So there are lots of topics to talk about. So we saw the investment was mainly driven by financial return, and the current, I'm currently raising a round, which seems to show that there's still a lot of demand for one investment. And on the other hand, we also saw a lot of strategic potential, which for us is always the ideal mix when we can provide both.
I see. So it's very much something in the works and something in development right now.
Yes, of course. In the 10 days we had to close, we obviously could not agree all details of a strategic cooperation, but it was enough for us to see that there is interest on both ends, and details are being finalized.
Well, thanks for sharing this info with us, though. In terms of the exits involving corporates in the mobility space, we do cover some of the exits where the corporates are either exiting investors, or in some cases acquirers of startups that have been backed by other corporates. So that's one area we try to cover in our magazine. But we saw very few. During last year. There were only seven of them, and you can see the geographical distribution of them on this slide. There were six exits in 2018 and one in 2017 from the seven that I mentioned on the previous slide. In terms of funding initiatives,
can you show the exits, because we had 3 exits last year, so I'm not sure whether that list of 7 is complete. Do you have an overview of the companies that exited?
We may have missed a few.
Okay.
We may have missed a few, so I'll be glad to double check that with you. Because it was basically you that announced a few exits, and I think GM had one, but I would have to double check, because not having the data right in front of me is a bit tricky. So in terms of funding initiatives, we saw a bit of a decrease in terms of funding initiatives centered or covering the mobility space. Between last year and 2017, we see that number of such initiatives was reduced kind of drastically from 30 to 18, and the dollars raised in those initiatives also experienced a significant drop, from 5.5 billion to 3.9 billion. Now, despite that there were some very noteworthy ones. There was the Hidden Hill Modern Logistics Fund, which was raised in China, and it claims to be the only China-based fund centered on the logistics space. That's worth $1.6 billion, and even though its name implies that it's a private equity fund, we do believe a lot of it will go into promising businesses that have been backed by corporates, or that corporates are looking into, in addition to having corporate backers and corporate LPs in it. So that fund was definitely of interest to us. Alliance Ventures, a billion dollar newly launched CVC unit by Mitsubishi, Nissan, and Renault. That one was also very much worth mentioning, and it definitely made the news among other funds that are listed here. Briefly, this is a map showing some people moves, new funds, new units being launched in 2018. I'm going to move very quickly onto government and university venturing, very, very briefly, so that we could have a few minutes for the Q&A. Deals in university spinouts from the transportation and mobility sector remained stable for the most part in terms of their number, as this slide suggests, and similarly, deals in the government-backed transportation space also remained relatively stable. Now, some people argue that governments may be interested in investing in the mobility space as much as they may be interested as much as they're uninterested, because if we were to have autonomous cars, that would reduce public revenues from transportation, from traffic tickets and things like that. But it would, on the other hand, greatly reduce road fatalities. So it's a bit of a double-edged sword for governments, one might argue, if you look at this sort of investments from a more sort of philosophical standpoint. So that concludes my part of the presentation. Now I'm going to give the word to Jim for a few questions to Ulrich. Jim?
Yeah, thanks very much, Canan. Really interesting data and obviously fascinating insights, Ulrich, particularly around sort of Lime. I've got a couple of questions myself. We've got some coming in from the audience as well, so do keep those coming. But I'll take the liberty of asking the first one. Just on the Lime, you mentioned you had sort of 10 days to close. Was that you trying to fight your way into the round, or you just interested in a bit of the blow-by-blow level, how you and Uber came to be pretty well much what looks like the strategic, most of the others, but with the investors? Was there anything about your model or your approach which kind of made you much more attractive to what seems a very hot syndicate?
Well, it was a very competitive deal. They were vastly oversubscribed, and we couldn't invest what we wanted to invest, but at least we could invest something. There was most of the investors were financial investors, but there were also some with a strategic component, like Google Ventures is. Some were probably more financial, but they also wanted to include companies that can help them along the way, and I think they saw that BMW might be able to help them going forward with being a successful mobility player. And for that investment, it was really key that we could move fast, and we had to do a shorter due diligence than usual. But the excitement level was actually so high that we had a unanimous decision to support an investment within a very short time. So for me, that's really a good example of why it's important to be able to move fast. In that time frame, obviously, it's not possible to get any serious business unit buy-in or even commitments or anything like that. So we appreciated being able to move fast, and obviously Lime appreciate that as well, and they saw a strategic angle for them that we can help them in the future. It was not about the money. They could have gotten the money elsewhere more easily, but they saw us as someone who could help them strategically going forward.
Really, really helpful. Thanks, Ulrich. And you mentioned obviously the model. If I think back to 2011, there wasn't a whole lot of corporate venturing activity in the mobility space from the existing strategics. General Motors had been around a couple of years before. A number of the other groups that you could have imagined having, doing corporate venturing from the space had yet to start. So just interested why you were able to get going then, and in particular sort of the structure you now have, 500 million committed, independence, as a team to be able to strike these types of deals without having to buy in unit. How important has that been in fact being able to attract the talent and deliver the sorts of deals and returns that you guys will do?
Yeah, the setup is very important to attract talent. People will not with a track record will not join you unless you have a good setup. You can be lucky, obviously, finding good people that don't have a track record yet. But obviously, it's always better if you're able to hire someone with a good track record. And so the first couple of years we did that with people that didn't have experience in venturing, I think myself included. And it was, I would say, not entirely unsuccessful. We just looking at those companies, their valuation right now is a multiple of what we invested. So I think beginning we were maybe a little bit lucky, and then in the second phase of our corporate venture unit, we got a good setup, and having good people on board and a strong team obviously helps a lot, and you need less luck to be successful, and for me that's a very good setup. And also I think what's maybe unique about us as well, we are not entirely financial. We have a financial setup, but we also have strategic goals. So BMW managed by giving us strategic goals to also encourage us to connect our companies with companies with BMW. Just last month, one of our portfolio companies landed a $150 million deal at BMW, which obviously is something is good for us. It's good for the portfolio company, good for the valuation, and so far that setup seems to work well. Having some of us have a BMW history, so we are still very well connected, but most of the team has a VC pedigree with a good track record.
Fascinating. Yeah, we've developed our GCV Connect platform within the Leadership Society to understand more how the corporates are trying to provide not just capital but customers, product development, hiring, and eventually potentially even an exit, to help support and deliver that added value, and work with other corporates to be able to share, and obviously other investors to share that sort of deal flow and opportunity. So it's really interesting. As it becomes public about what that portfolio company is, we'd love to learn more now. So I'll turn now to a question from Jose Lazaro from Eman, and I'll sort of read this out, and then Ulrich, it'd be very interested in your perspective. Jose says the car is turning into a crowded space for software. How relevant do you consider industry standards and or the prevalence of certain operating systems, such as Android Auto, in a quick convergence and efficiency on areas as software performance, predictive software failures, cybersecurity, etc.? So slightly long question, but interested if you've got any perspective on that software.
Yeah, I think in theory it would be good to have standards. In practice, OEMs traditionally haven't been very good at agreeing those standards. If you just take charging, for example, when it's obvious and it's helpful for everyone to have the same charger that goes into the vehicle, even on something like that, OEMs were not able to agree on one solution. So, even when when the benefit is very clear, it's not easy to get a dozen or more, 24 of companies aligned on one solution. And in software, it's not any easier because every company has their own solution. Every company has a history of what their software is looking like. And getting this aligned, it sounds like a very good idea. But in practice, I have my doubts whether this is going to happen anytime soon. I think that Android and iOS will find their way, or already have found their way, but will continue to find their way into the vehicle because customers are looking for an experience that's similar to their mobile phone experience. So that's probably some of the explanation why those systems why they are in the vehicle right now. But beyond that, generally, I'm a little skeptical about standards for software in vehicles.
Do you think that creates an opportunity for groups like, say, Tesla, which are very much trying to open source the development of their electric vehicles and say, hey, here's what we've done, take it on, do different issues? That shift from proprietary technology. If I think of groups like in a different space, Lockheed Martin and Boeing, and they sell the government's proprietary technology, and someone like Sierra Nevada would be very much more open platform. Do you think that within the sort of cars and OEMs, that same challenge will lead to the groups such as a Tesla, which can say, hey, you get it, take it out, you develop, because we know from the history of software that that's a much more powerful play.
Yeah, I think so. I think it's a good opportunity for non-traditional players to find their niche, or come up with a product that's appealing to customers, because customers don't care so much about whether it's open source or not. They can compare. They care about a good experience, and some of those players are able to provide it. They are also more less risk averse. I think there's OEMs are, for a good reason, sometimes slightly hesitant to introduce software prematurely, because it doesn't meet the standards that they have set up. So we know that there are some risks involved in some of the approaches of companies that are coming up. Nothing serious has happened. There were some incidents, but nothing serious has happened so far. But obviously, a traditional OEM wouldn't want to risk having some serious software issues because the software is open source, or because they have done something that is very different from what they've done in the past. But as you might rightly mention, it's an opportunity for companies that want to enter the market, and I think customers are open to that, and they appreciate the experience that they get in many cases.
Fascinating. And one extra question: if you look at some of those larger deals that have been done, they're from traditionally fairly new companies. I'm thinking in particular Didi Chuxing and Grab. These are companies that have raised billions, even sometimes 10 billion plus. And yet they're reinvesting very quickly in other companies, in other countries, or in other services. That speed of iteration and change and trying to get ahead of that innovation cycle is it's really eye-opening. We've not necessarily seen it in other sectors so rapidly and so quickly. I'm just wondering, from a BMW's point of view, does that, do you almost think sometimes, well, if we can find a right platform company below and give them more money, they might be quicker and faster, and actually, they become the bigger company than we would be, so it's almost like a sort of passing on the baton. Is that a sort of a risk or an opportunity if you look at some of these big companies?
I agree. The pace is fast, and sometimes it's it would probably be challenging to launch something like Lime within BMW. So it is. I think it's the right move to, especially when it comes to those capital-intensive companies. And Fair, for example, is another example in our portfolio who grew to a $1 billion company within less than 24 months. It's a very capital-intensive business, and for those businesses, the setup of raising money from third parties is key. And traditional corporations are not always willing to provide that money easily. So, for BMW, the important thing is we want to be connected to those companies, but we would probably not fund them in-house and create something like a Lime in-house and fund it just ourselves. So for us, the good strategy has been to use our venture capital unit for those connections. Try to connect them with BMW by enabling corporations, and for us, that's the right solution. I don't think we would consider, spending billions of dollars on one single company that might potentially be relevant in the future.
No, yeah, makes sense. Fascinating. Thank you, Ulrich. I'll hand back to Kalyan to do the final close, but let me just say thank you, obviously, Kalyan, for organising this and hosting this, and obviously, Ulrich, it's been a great pleasure to catch up and hear some of your insights.
Thank you very much.
Two more questions to Ulrich, very briefly, if that's okay. Mostly on the fund managing side of things. Ulrich, you are investing in a very, very dynamic space that's undergoing a lot of disruption, and you mentioned that you're both financially and strategically oriented. So I'm just wondering, how do you guys measure strategic returns or strategic value? That's my first question. My second question is, the development of the fund that you're running has been very successful. I mean, you've been fortunate enough to see the money that you have under management grow almost 6 times. And aside from that, you've been given more autonomy than you had previously, and also your mandate was extended. So obviously, I believe that there's quite a few things that you guys have done right in dealing with your corporate parents. So perhaps you could share a few tips with our audience and with other corporates that are potentially seeing this or will be seeing this on YouTube and so on afterwards.
Yeah, on the first question of measuring how to measure strategic value, it's not easy. I had a keynote about that with GCV in New York last year. The way we do it, we don't try to measure it by the numbers. We try to measure the success of our various corporations. So we are very transparent to which extent we are cooperating with every single portfolio company, and sometimes we don't cooperate at all. Sometimes there are some projects going on, and sometimes it's very comprehensive. We have an up-to-date list at any given moment of what kind of corporations are going on, which business units are interacting with our portfolio companies, and what kind of business is happening between BMW and the portfolio company. It can go both ways, BMW selling something to the portfolio company or the other way around. So we are trying to keep a tracker. Everyone who is in charge of an investment is supposed to keep this tracker up to date, and we share the summary of that with the highlights every time we are talking to our steering committee. We share the biggest successes, the newest developments that they might be interested in. And there's one owner for every project. There's an owner on the business unit side, and they can reach out to him at any time to get his impartial view of how the corporation is going. So we've tried to communicate very openly and allow our steering committee to be in touch with business units whenever they want. And that hopefully has made them confident that we don't have nothing to hide, and they can look at us at any given moment. As to your second question, I think for our success, the key was buy-in from a board level. And without that, we would have, after 5 years, it went well, actually, with good successes, good outcomes, good corporations, we would not have gotten to the next level if we hadn't had that top level support. And I think to get that, it's important to have established a personal relationship with them, explain to them how this works, get them excited. My recommendation is to spend most of your time trying to get visibility to top management, because on a lower level, people are not willing to take that risk.
Right.
They have nothing to win and not to lose. And on the board level, that's what they are. They often have the vision, and they also often have the willingness to take a risk, which is not always the case in bigger corporations in the mid-management level. So I think that was for us also a little bit of luck that we had someone in the board who was very innovative, very open-minded, who supported us and who then helped us getting this decision approved by the entire board. Without him, it wouldn't have happened.
Right. Fascinating. Thank you so much for sharing this with us. Thank you so much for being with us on this webinar and sharing your insights and your valuable perspective of an investment practitioner from the corporate venture capital space. True pleasure to have you here, indeed. So I suppose that concludes our presentation. Thanks so much to the people who attended the webinar. Those who signed up but were not able to attend, they will get a copy of the recording and of the slides. And also the recording will be uploaded on YouTube a bit later on this week. In terms of our next webinar in February, it's going to take place in mid-February, and it's going to be focused on impact investing. Jim, would you like to say a few words about that? it seems like Jim might have dropped off. So stay tuned for further announcements on our next webinar, and have a wonderful day or wonderful evening wherever you happen to be in the world. Goodbye.
Thank you. Goodbye.